Hi, this is Jeffrey Kerr at Kerr Financial Group, and today is January 20th, 2023, and we're off to a new year. Um, so far, the new year is much different from 2022, and the financial markets, at least from their perspective, it's good riddance to 2022, and let's go with change the game plan for 2023. Let's look at 2022, though. It was a historic year, and just want to reflect on and illustrate what happened. And the Dow was down 9% for the year. S&P was down 19% for the year. Nasdaq led the way lower, down 33%, and the Russell 2000 was down 21%. But the losses were not just confined to the stock market. The bond market had a terrible year too. The Barclays Aggregate Bond Index, which is a widespread, tries to capture what's going on in all different sectors of the bond market. Mortgages, municipals, uh, corporates, other government bonds, and like that. And that index total return was down about 13%. So, even with a couple of percent of interest payments coming in, the index was down 13%, which is pretty significant for a fixed income index. Also, the long Treasury, the U.S. government bond, index for the longer dated bonds was down 29% for the year. So, this is, the main cause of the bond market and the stock market was higher interest rates. Interest rates went up throughout the year. The Fed raised interest rates. Also, the markets took interest rates up, worried about inflation. Inflation went a lot higher, and all this combined to put a real squeeze on the economy and on the capital markets, the financial markets. So far, this year the narrative out there for the increase in 2023, and let me give you those numbers. The Dow is flat for 2023 in the first 3 weeks. S&P up 1.5%, Nasdaq's up 3.7%, Russell's up a little over 4%. So the stock market, is shaking off 2022 and looking forward to a new year. What's interesting is that the things that have been leading. Again, the Nasdaq was the leader on the way down last year, and it's rebounded pretty strongly in the first 3 weeks. But the some of the speculative things that really got hit hard in 2022 have been the leaders so far in 2023. It's really not good price action, but it's what's going on. And the narrative of to defend the market going up has been several things, but predominantly the pivot. The Fed's going to stop raising interest rates, and that the Fed's going to pivot, and that those things. And I don't think they're going to happen. And I'll discuss that in a few seconds here. But that's the narrative: is that every softer economic data point that comes out is celebrated because hey, the Fed can stop raising rates sooner, and we get back to the easy money days of low interest rates and high liquidity in the markets. Again, not sure it's going to happen, but that's kind of the narrative that's being pushed out there. Another point would be the economy is going to be a soft landing. That the recession is not going to be that bad, soft landing, and then we'll return to the growth, and that combined with lower inflation coming down and like that. I think all of those points are easily debated, and I'll kind of go through some of what I believe the reality is for 2023. Number one, I don't think the Fed is going to stop. Powell, we have a meeting in the Fed. Next Fed meeting is February 1, and the Fed's going to raise interest rates again. So, quarter of a percent is what's expected. And then there's another meeting in March. There is going to be another quarter point increase expected. So, those kind of rooting for and calling for the Fed to back off and pivot, I don't think it's going to happen right away. And I think the expectations are after the March meeting is maybe hesitation, but I don't think there's much expectation on the Fed's part to start lowering rates, right after that. I don't think it's going to happen. Also, the QT, the Fed is reducing its balance sheet, not providing the liquidity that they did for 10 years or longer, going into this, that they were buying bonds and, supporting the liquidity of the markets. That's not happening anymore. They are pulling money out. The inflation uh, data point, I think, yeah, inflation came down from the 9% that it peaked at, in this middle of 2022, but it's not going back to 2%. Looks to be, range of about 6.5 to 7.5% inflation growth, and that's a real damage to the markets and a real again obstacle headwind. The layoffs, a lot of the layoffs in the headlines. Today was Google with I think 10% of their workforce, and Goldman Sachs and Facebook and Amazon and like that. That's all gonna have a suppression of economic activity as people get laid off and not going to be consuming as much. And also, I think with the higher interest rates that we've had over the past year, the other the cost of capital is a problem for companies that need to borrow money to survive or roll over debt and like that. It's going to be at a much higher interest rate if they can do it at all. The liquidity is tightening and the cost of capital is going up significantly. That then will be pressure on profit margins, and you're likely to see continuing, which started in 2022, continuing uh, declining corporate profits. So I think all this stuff. I think there's still a lot of risk in the economy, in the markets. So I view it as managing risk when approaching the investment process as being very critical here in 2023. And I think Curve Financial did a good job of doing that in 2022. And I think it's going to be again a difficult process, but something that's going to be required in 2023. So good luck out there. If we can help at all, give us a call, email, text message, whatever is your preferred way of communicating. And look forward to speaking to you again. Let us know any suggestions, questions, and we'll talk soon. Thank you. Goodbye.